Hello, chart watchers, and welcome to this Friday, May 4th, Market Watchers Live Show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the market is bouncing nicely after a non-farm payrolls report came out this morning. Dow Jones Industrial Average up 253 points, the S&P 500 up 25.5, the NASDAQ up nearly 100 points, the Russell 2000 also following suit up 17, well, a little over 16 points today. 10-year Treasury yield had backed all the way back down to its 20-day moving average, but bouncing off of that, currently up 1.5 basis points, back to 2.96%. Volatility index back down the low 15s, getting very close to the low that we saw back in the second week of March at about 14.5. Technology leading the market to the upside today. You can see up 1.45%. Consumer staples, which has really been a laggard for quite some time, having a really nice day today, up 1.35%. Cyclicals also doing well today. It is up more than $1. Apple having a strong day after Berkshire Hathaway announced that they had bought 75 million shares of Apple. Walt Disney having a strong day. I wanted to show you this chart because yesterday it looked like it was threatening a breakdown, printed a hammer, and you can see the beautiful rally off of that. Disney was the second best performer in the Dow behind Apple. And, of course, we got to mention one company that's having a rather ugly day. Fluor Corp missed on their top line, missed on their bottom line. This is actually a company that's been in a pretty strong pattern. You really don't want to surprise Wall Street like this. Fluor down more than $12 today and over 20%. With that, let me bring in my co-host, Aaron. Happy Friday, Aaron.
Yes, happy Friday, TGIF, and may the 4th be with you.
There it is, Star Wars Day. May the 4th be with you.
Yes, indeed.
Yeah, this is Friday's my third best day of the week, right behind Saturday and Sunday.
Right? Yeah, I have to agree with you. I do enjoy my Fridays. I think it's going to be date night tonight, so I'm pretty excited about that.
Well, I just got tickets to the Wells Fargo on Sunday, so I'm going out. I'm going to challenge Tiger Woods on Sunday, maybe to a little putting contest before he goes out tees off.
Yeah, maybe a challenge for you, but not so sure it'll be a challenge for him.
Thank you very much for that positive feedback. And today, though, we do have Chip Anderson with us. Chip, how are you doing?
Hi, Tom. Hi, Aaron. I'm doing great.
Awesome. I know you got some good stuff for us today. Hopefully I don't ruin your your presentation too early. I'm not going to let the cat out of the bag. What's that?
You'll figure something out, I'm sure.
I will. I'll figure out something to ruin the day. But anyway, I know we got a busy, packed session today, so why don't I turn it over to Aaron? You can take it away for the announcements and today's agenda.
Indeed. And we're going to start off next week with, on Tuesday, Tom's got a workshop. Do you have a title yet?
Of course not, but I am lobbying for survey comments today. So after the show or as you leave the room, make sure you fill out that survey. And if there's a topic you'd like for me to cover, suggest it. And perhaps I'll pick one of those topics for the workshop on Tuesday.
Yes. And on Wednesday, we have Jeffrey Salt coming in for the guest appearance. Should be very interesting. And on, okay. There's more next week, but we're going to make you wait. Today's agenda, we're going to start off after the technical news with everything stock charts, of course, with Chip, who is here. And we'll follow that up with chart breakouts. We're finally getting a nice up day in the market, so there are a few of those breakouts to look at. 10 and 10 to 1, we're going to use our first symbol will be Goldman Sachs. So if you want to go look at that. And finally, I will finish it all off today with the sentiment update. And with that, I'm going to turn it back to you, Tom, for the technical news and headlines.
All right, it sounds good. Let me go ahead and pull up my 10-year Treasury yield chart. And you can see here the 10-year Treasury yield, as I mentioned earlier, is near the high of the day or at the high of the day right now, 2.96%. It is up 1.7 basis points now. We've talked a lot about the fact that we broke out above that February high on the yield. And by moving above 3%, we're now challenging the highs that we had back at the beginning of 2014. At 3.05% yield resistance level is a huge one, as it would suggest that the long-term 27-year downtrend that we've been in Treasury yields could be reversing back to the upside. Of course, at some point it had to happen. We were at all-time lows I think we got down as low as about 1.3 or 1.35% on the 10-year Treasury yield, and we have reversed off of that. If you wanted to take a look, I've got a 15-year monthly chart. We can pull this up, and you can just got to get a sense. But here you can see the downtrend, and a downtrend is simply, it consists of lower lows and lower highs. And you can see here off of this reaction high, we had a double bottom in play below that 150 level. And now as we move back up, this is a really critical level technically, because a breakout here would then end that streak, really 27-year streak of moving lower, putting in those lower highs and lower lows. So watch that closely to the upside. Now, I still believe that rates are low enough that the market can withstand some additional movement to the upside in the yields. Interest rates moving higher, and on the one hand, actually takes money out of the bond market. That's what triggers the higher yields. Money comes out of the bond market. That money then is available to move into equities. That's why in the short term, we have a very strong positive correlation between 10-year Treasury yield and the S&P 500. You can see that the move we made into January on the S&P 500 to all-time highs coincided with that yield moving up as well. So, there's obviously some consolidation going on in the S&P 500, but if this yield breaks out, I think that would be bullish, unless the yield is moving up to fight inflation. That would be a different ball game altogether. At this point, I don't think that is an issue. I do want to mention, though, that we had non-farm payrolls out. Let's go back and take a look at that 10-year Treasury yield again on the daily chart. The non-farm payrolls came out for April, 164,000 versus the expected 191,000. So a little disappointment. Private payrolls also disappointed, 168,000 versus 190,000. The April unemployment rate, 3.9%, the lowest rate we've seen in about 17 or 18 years. 3.9% versus 4% expected. And April average hourly earnings rose 0.1% versus the expected 0.2%. So little in the way of wage inflation there. But looking at the 10-year Treasury yield and the stock market in general, over the last 2 or 3 months, we've been getting really good earnings reports, and the market can't capitalize on it. Today, we get non-farm payrolls and private payrolls that come in well below expectations. And I thought it's kind of interesting that the S&P 500 is having a very positive reaction to negative news. So if you're always trying to figure out what the market is going to do based on the fundamental news, I wish you the best of luck. Normally, it doesn't work out that way. It's not that easy. Instead, I think you got to focus on the bigger picture. And for me, I'm still looking at, if we look at the S&P 500 on a longer weekly basis, I think we had a very, very steady move to the upside. While this has been kind of a roller coaster kind of a ride, I think we are consolidating, still holding on to the 50-week moving average, which currently is at 2587. And if we look at that daily chart on the S&P 500, we have had two daily closes at 2581. So to me, you put all that together, the S&P 500's got great price support at 2581. You've got that rising 50-week moving average, which we have not violated, going back all the way to early March 2016. So that's a little more than 2 years ago since the S&P 500 has seen a weekly close below that 50-week moving average. So I still think everything remains bullish, although scary. I would call it cautiously. I'm cautiously bullish at this point. There are a couple things that I'm going to be watching really closely. First thing I'm going to go ahead and pull up is, rather than recreate this chart, I want to show you under the current outlook today on my blog, a chart that I put in here, the transports versus utilities. Now, the Fed keeps telling us that rates are going up. Fed keeps telling us that the economy is strengthening. If that's the case, when rates are rising, utilities should underperform. And when the economy is stronger, the transport should outperform. So what you typically want to see is the transport versus utility, the relative ratio moving higher. The S&P 500 throughout this move to the upside, you can see that it has coincided with a transport versus utility ratio that has been moving higher as well. It's not perfect. Yes, we've had some moves up in the S&P, and this ratio is consolidated. But overall, we're putting in higher highs and higher lows. I pointed this out because this ratio has come down to a key relative support area. This was relative resistance. This was a high that was established. We pulled back. And with that huge move in November and December and into early January. Look at this move that we had on the S&P 500. With that, we saw a beautiful move up in this ratio. To me, that is confirmation of a bull market. We've pulled back. We've seen this ratio pull back as well, but this is the first key area of support that I would be looking for. So I really would like to see transports begin to turn higher. And I think if we could break this trend line, similar to the trend line that we broke here, I think that would confirm that the support levels that we've seen on the S&P 500 are likely to hold, and we would be ready to potentially resume the bull market, although that wouldn't be confirmed until we see the S&P 500 actually break out. I wanted to mention the banks. So let's go back here for a second and talk about the banks for a minute. If I pull up the Dow Jones U.S. Bank Index, we talked about this yesterday as it was threatening a breakdown. Look at that candle. That's a nice looking hammer hitting support. Actually looks like it was going to break below, potentially on a closing basis, below that March low around 455. We had intraday lows go as low as 450. So that was the zone that I've been watching, 450 to 455. In fact, I think when the bank index was down around 455, I mentioned that from a reward to risk standpoint, if you like banks, that was a great time to consider banks. We're bouncing off of that. That's really important. I want to see the banks continue to move to the upside. Banks don't need to be the best performing industry group during a bull market, but you do want them participating because they're the ones that provide the credit that allows our economy to continue to expand. And if banks start underperforming, it is a warning sign. So we want to see that support level here hold. Also wanted to mention within the banks, there are a couple of different ETFs. You've got KBE and KRE. The KBE is the bank ETF, and the KRE is the regional bank ETF. Okay, now the reason I point this out, if you look at the regional banking ETF, you see that we're putting in slightly higher lows. And when we went down here yesterday, we really didn't get down to those lows. If we look at the Dow Jones U.S. Bank Index, again, you'll see that we actually put in lower lows, and then we're threatening a breakdown yesterday. So the regional bank ETF is holding up much better than the bank index itself. So if we're looking at the KRE, I wanted to point this out. KRE versus the KBE, and I am going to change this. Let's go back a couple years and do a weekly. But what you're going to see here is that whoops, that's not what I wanted. Let's try that again. KRE versus KBE. Let me just go ahead and pull that up first, and I'll change the chart settings here. Let's just leave it at that. We'll just do the line chart. I like to use a line chart whenever I'm looking at ratios. And look at what's going on since February. The regional banks are wildly outperforming the banks, the bigger banks. So I think this is important to note because with the rising treasury yields that we have seen continuing to move higher, with the rising dollar, some of these regional banks are easily outperforming some of the bigger banks. And I wanted to point out, a couple of the stocks that were in these ETFs. By the way, both of these ETFs are very widely diversified. So if you're looking for a possible investment vehicle to track the banks, I think this is a key area one certainly look at. Voya Financial, look at the equal highs coming across the higher lows. I think we've got a test here of a trend line in an ascending triangle. So I think, as you go through some of these individual stocks, I think they're set up much better than some of the stocks in the regular bank ETF. These regional banks, I think, tend to look a little bit better. One last thing I wanted to do before we get over to Chip, I did want to mention Apple, first of all. Look at this chart. Last 5 days, huge move, probably up about 12% or so, challenging a high. Let's see if we can get this breakout. Volume is very strong today, but Warren Buffett disclosed that Berkshire Hathaway has purchased 75 million shares of Apple. I think the market liked that. Disney, as I showed you earlier, this is going a little bit in a different direction, but you can see yesterday it went down, looked like it was breaking below the March-April lows, printed a hammer, now bouncing nicely. A breakout above about 102.75 would be very bullish here. And then I wanted to mention one stock that reported earnings If you were here yesterday and you listened to Bruce Fraser, he talked about Shake Shack and the fact that he owned a position in it, but he warned you to be careful because earnings were coming up. Look at the company. He said that it looked like it was being accumulated, and he really liked that, using that Wyckoff approach. Check out the results here. We tried to get Bruce, but I think he's on an island sipping on a margarita somewhere. But anyhow, with that, I'm going to turn it over to Chip. Chip, take it away.
Thanks, Tom. Let me switch over the screen here. And get everyone going. This is, so I want to do a talk about sector rotation with perf charts and BPIs. Sector rotation is something that we've done at StockCharts since actually the very beginning of the website. It's a lot of what Tom sprinkles into his commentary and Aaron sprinkles into her commentary. John Murphy was the first person that I read that went into this in great detail with his intermarket analysis. But the goal of sector rotation is important to keep in mind. And it's also, I'm going to show you a picture here that hopefully you can, when you hear Tom or Aaron talking about the relationship between sectors, this picture will come into your mind and it might become clearer. Ultimately, the goal of sector rotation, however, is to find out, are there any big forces that are moving the market right now? And the answer to that sometimes is yes, and sometimes is no. And most of the time is, it depends, and partially yes and partially no, and that kind of thing. So the question is really, how can we visualize those big forces? And what should we look at to see them? So first question is, where do we get the data? It says, we still use the 9 S&P sector ETFs because of the large amount of historical data that we have. So that's a decision we made back at the very beginning of the website. Ultimately, is 2 years ago now, a year and a half ago, Standard & Poor's changed the number of sector ETFs that they were using to track sectors from 9 to 10. And we want to move to that 10 sector model. We will be moving to that 10 sector model soon. But we're waiting for more data to accumulate so that our sector rotation charts don't become overly short. And you'll see that when I show them. But it's the question is, where do we get this? So these ETFs are very, very useful. You'll see Tom, he was already showing them earlier today. You'll see Aaron talking about them as well. This is the XLK, the XLP, the various S&P sector spider ETFs. And so we think they're very, very good as proxies for what's going on in the individual sectors. Now, the rotation work that we do is based on a model developed by Sam Stovall and mentioned by John Murphy in his books, The Sector Rotation Model. So let me take half a second and show you that model. This is the picture that I want people to have in their heads when you hear the term sector rotation and you think about it. So what are we showing here? Well, first off, what's important to understand is that all other things being equal, there is a order to how sectors should outperform the market. And the reason for that order has to do with the underlying business cycle, which is shown here as a green curve that goes up and down, and then it repeats. As you go off the left side of this chart, you come back on the right side. So that's just a cycle. The business cycle exists, and the point is that the market tries to anticipate the business cycle. So the red line shows what the market is doing, and it shows, for instance, the red line peaks before the green line peaks. And again, that is to indicate, based on Sam Stovall's work, that the market generally will precede the business cycle. And because that's what everybody on Wall Street is trying to do, is to predict the business cycle. And they actually can do a reasonable job of it. So as, for instance, we get into a early recovery phase of the business cycle and towards a full recovery phase, the market itself is already peaking. And in fact, the market will start to decline just before the economy itself, the business cycle, hits its top, its peak. So given that, and the other assumption of this picture is that all phases of this cycle are the same duration. This again is a model. This isn't reality. It shows everything happening kind of in an equal time frame. As we'll see, that doesn't occur. But if it did, then you would see things like cyclicals peaking, and then technology would peak as investors became more anticipating the upturn in the market. They get more excited about more risky stocks like technology. Then the economy itself starts to pick up and industrials do well. The theory being that factories and other kinds of manufacturers will start to invest, and they'll start to do better. That in turn will lead to a demand in materials. That in turn will lead to a demand in energy. Energy typically is the stock, although combined with a little materials and a little consumer staples, these are the sectors that will be doing very, very well at the peak of a market. Over time, however, the market will start to fade, and that's when the defensive sectors start to take over. So the sectors here on this side of energy, to the left of energy, might be called the offensive sectors or the bullish sectors, and the sectors to the right, consumer staples, healthcare, utilities, financials, are more defensive in nature, especially consumer staples. So consumer staples is kind of the opposite of cyclicals, which is consumer discretionary is another name for cyclicals. And so you see those are kind of at opposite ends of the cycle. In addition, utilities is essentially, if utilities are doing well, that means the bond market is doing well. If the bond market is doing well, that means that the people are not happy with stocks. So technology is kind of the opposite. Technology industrials are kind of the opposite of utilities. If people are excited about stocks, they're going to be in these sectors, and if they're not excited about stocks, they're going to be in utilities because they're really in bonds. Financials, similar situation. They do well when the bond market's doing well. However, again, an uptick in financials might be the first thing we look for, and then hope as we do sector rotation to see upticks in cyclicals, followed by what we're really going for, upticks in technologies. Technologies generally lead a strong rally. So anyway, that's the model that we want you to keep in mind as we go through this stuff. So how can we look at where we are now and what the actual data is? Well, we've come up with a tool that we try to use to visualize this. It's called perf charts. It's by no means a perfect tool, and sector rotation in general is not a perfect science. There is a lot of interpretation involved. But perf charts show performance changes over time for several symbols overlaid on top of each other. On the left side of every perf chart, everything starts at 0, and on the right side, it will be the percent change over the course of the chart will be what's displayed. We have an interactive perf chart tool, which I'll demo in just a second. It can be found under the free tools area. It can also be found in the members workbench. We have links to it in several different places. When you pull up the tool, however, as I'll show, you want to select the S&P sector perf chart, and then you'll get the full display that I'm about to give you. There is a slider below the chart that controls this time span and makes it interactive. And as I mentioned, this S&P sector choice, if you choose that from the predefined perf charts, then you'll see all these sectors. And not only that, but we will switch over to histogram mode, which shows you the ending percentages, which is the most important thing for sector rotation. So, and then I'm going to do my demo in just a minute, but I wanted to tell you both parts of the demo before I do it. In addition to the perf chart demo, after that, I want to confirm anything that I think I'm seeing on perf charts by looking at our bullish percent indexes. We also provide bullish percent indexes for each of those 9 S&P sectors. And a BPI is the percentage of stocks within a group, in this case within a sector, that have bullish point and figure charts. So point and figure charts, I showed that a long time ago, the X's and the O's. Computers can very easily determine if a P&F chart is bullish or bearish. And so they can look at all of the P&F charts in a group and quickly come up with the percentage of those charts that are bullish or bearish. And the bullish percent is what is in the BPI. The BPI is a market indicator, meaning that it is a ticker symbol. It's not a technical indicator that you select from a dropdown. Instead, you type in a ticker symbol. They're all going to start with $BP. And so we have different BPs for each of the sectors that we're going to go over. We also have them for markets and other kinds of things, but I'm going to focus on the sector BPIs. And the best way to look at those are using our candle glance page, and that's what I'm going to show once I'm finished. With that, let's get to the demos. So here we go. Here is, here is the sector BPI, or I'm sorry, the bullish, perf chart, S&P sector ETF perf chart. And again, you can get to that from the free tools page. You can also get to it if you're a member logged in over here under the extra control center. the first thing you do is you click on perf charts. And then the next thing you standard chart looks like, with the lines going all the way from 0 over on the left to whatever the percentage that they end up with on the right. Use the slider to move back and forth through time, and you can drag the edges of the slider to change the duration, the start and the end date. So perf charts are very useful in and of themselves for a variety of things, not just sector rotation. But if you want to do sector rotation, you're going to go to predefined groups and you're going to select S&P sector ETFs. When you do that, we're going to give you this page, which is a special version of our perf chart page. And again, I've automatically changed it from line mode to histogram mode. In histogram mode, we're just taking the final values that you see here on the right side of the chart and turning them into histogram bars here on our chart. And you'll notice we order these histogram bars in the same order that our S&P sector model was in Sam Stovall's model. I included a picture of the model down below here. Cyclicals, technology, industrials, materials. That's what we have here. And now we can start to look at 4 sector rotation effects. The first thing we have to decide is what duration do we want to use. By default, it has a 200-day duration on our perf chart. We can, as I mentioned, we can drag the slider, the edges of the slider left and right to change that. We can also, this is very important, we can also right-click in the middle of the slider and then select a predefined duration. And for sector rotation, there's several different choices depending on if you're looking for short-term effects or longer-term effects. I always like the 3-month, or at least to start with the 3-month duration. It gives me a good overview of what might be happening. I can then choose to shorten that or lengthen it, depending again on what I'm interested in finding. Now, what I wanted to point out is when we're doing sector rotation effects, we're looking to see, are there clusters of up positive sectors that are joined together, or are there clusters of down negative sectors? And if so, does that give us an indication that there might be sector rotation occurring? In this particular case, right now, right off the bat, I would say this is the kind of chart we don't want to see when we're looking for sector rotation effects. They may be going on, but there may be something else that's obscuring it. In other words, what we're seeing here is we're seeing up and then down, and then up and then down, and then up and then down. We want to see something more where there's a lot of stocks that are up over here maybe, and a lot of stocks that are down over here. So clusters of up and downs. Now, the good news is if I just go back a little bit, and I'm going to start to go back. The way I'm going back, by the way, is I'm pressing my left arrow key on my keyboard. You press the left arrow key on the keyboard, it takes you back just one day. And that allows you to very quickly kind of move to a specific date. And so look at this. What we've got here, remember that the chart circles around. So we got here now is we have 1, 2, 3, 4 sectors that are positive, and then we have 1, 2, 3, 4, 5 sectors that are negative. So that's a nice kind of sector rotation effect. It's not too long ago. That was mid-April when this chart happened. I can actually even make this effect more obvious by right-click. I'm right-clicking on the chart here with my mouse. That's a right-click. And then I can do show cycle line. So right-click, show cycle line gives me a visual tool, this yellow line, that I can now click and drag to just move around on the chart. It's just a visual aid for looking for these kinds of things. And so notice as I move this line kind of right about here, I would say the majority of the histogram bars fall underneath the yellow line. They fall between the yellow line and the zero, the horizontal zero line. And so that kind of indicates where this cycle might be. And so then I'm interested in, okay, where is the top? The top in this case is right at the end of financials, the beginning of cyclicals. And if I was able to see this effect exist for a while, then I would be very, very interested in that, because in this case, it would mean the market might be trying to move from a defensive posture over here into a more bullish and offensive posture. Again, technology is leading, cyclicals doing well. These two doing okay and starting to fade. That indicates that we might be at the beginning or trying to get to the beginning of a bearish part of the cycle. The other thing is we see weakness in the stocks that do very well at the top of an economic cycle. So this particular chart is just 3 months, and it was again ending in the middle of April, was indicating some very positive things about the market and about the economy. We could go further. We could right click and select, for instance, the past 6 months, and then we would look to see if we had confirmation of what we thought we saw in April. We may or may not. Part of that depends on the market's memory, and part of it depends on if there was anything else that was affecting things. Here we go. So I've just, with this particular chart, ending towards the beginning of April, I see again weakness in the middle to bearish part of the sectors, and I see some strength in the bullish side of the sectors. Now, it's always good. So as you can see, sector rotation is not a exact science. There's a lot of interpretation involved. Whenever that's the case, you want to try and get confirmation of what you think you see. And as I mentioned, another way to get confirmation is to go and use our sector BPIs. So I'm going to go back to the members dashboard, or I could go to free tools, and I'm going to come down here and find our candle glance tool. So candle glance allows us to see several charts all together, all at once. And they're mini charts, and they fit very nicely on screen. And so we have several predefined groups of candle glance charts. So I've scrolled down to the bottom. There's a button here called predefined groups. And you'll see that one of the predefined groups is sector bullish percent indexes. So I'm going to select that one. And then I'm going to make sure, I always make sure that I see these in 3x3 in a 3x3 display. So I resize my screen just to make sure that everything is in a nice. And so these are also in the order that we're interested in, with consumer discretionary, in other words, cyclicals, starting here, then techs, then industrials, then materials, then energy, which should be good, doing good at the top of an economic cycle, staples, healthcare, utilities, and finance. And so what I'm looking for here is a couple of things. First off, I'm very interested actually in the scales on the right side of these. The ones that we automatically scale these charts, and you can get fooled. It can look like a sector's doing really well when in fact it's very close to the bottom of its chart. In this case, we see the consumer discretionary, the cyclicals, starting to improve. The short term, the blue line is the short term moving average, starting to improve. However, the long term is still flat to down. We see technology stocks starting to improve, although again, the longer term moving average is flat to down. We definitely see industrials still going down heavily and getting to the bottom of their BPI range. BPIs again go from 0 to 100. Materials aren't too impressive. Energy has been going on a big run, and that is still looking very impressive from a BPI perspective. Staples down, or moving down, and going down right now. The BPI numbers, by the way, are updated at the end of each day. And so these are charts as of yesterday. They don't include today's information, because we have to run the calculations, and we only do that after the market closes. Ultimately, though, we can see utilities are also in a big uptrend on these charts. Everything else is kind of flat. So we have energy and utilities doing very well on the BPI charts. And so that kind of contradicts my theory, my hope, that things were starting to turn around. I would say at this point, the BPI charts are not confirming that particular interpretation. My goal here is just, again, to remind you that, or to show you how to use the tools, to show you how they can be used, and to remind you that you want to try and get confirmation whenever you have something that's so subjective. So hopefully that will help. Again, Tom and Aaron, they talk all the time about how if staples are doing well, that means discretionary and cyclicals are not doing well. Now, hopefully you'll be able to use that picture in your mind, and it'll start to make even more sense. With that, I'm going to wrap it up. I have a link if you want some additional information. Here's the link that we put together. This will just take you to our article on sector rotation in the Chart School area of the site. So with that, anybody questions, or?
Were there any questions in the chat room, Aaron? You might be muted there, Aaron.
Yeah, there's a few. Of course, some are, usually, Chip, when you come in here, it's always requests for something. Can you do this? Can you make it do that? The one thing somebody did ask though is how, can you use RRG charts along with this for confirmations?
That's a great question. First off, I love to hear all the suggestions people have for how we can make our site better. I'm all for that. Please keep those coming in. In these kind of sessions, obviously, I'm focused on a particular topic, but I still read all that stuff later. Second off, yes, RRG charts are an absolutely awesome additional way to confirm or maybe look at this sector rotation stuff in a different light. I still suggest, though, that the Sam Stovall model might help you even when you're looking at an RRG chart. Keep everything straight in terms of if this sector is doing well, then we hope the next sector would do well. That would show strong sector rotation effect.
All righty. Let's see what else. That was kind of the main ones. I know, when you were looking at those BPI charts, somebody said it would be nice if they all went from 0 to 100%, but I'm thinking really what you're looking for is just which direction they're moving.
Yep.
Okay. Let's see. Anything else? No, I think the rest we've either answered or covered. So.
Well, terrific. Just keep sector rotation in mind. It's something that you probably don't need to review every day. I would review it like maybe once a month or so. And I think it'll give you a higher level perspective about where the market's at and where it might be going.
Yeah, I would just add too, Chip. I mean, you mentioned and credited John Murphy as being the first person that you've read who, really got into a lot of this rotation and looking at different areas of the market and how certain areas are performing versus other areas. I did the same thing. John Murphy, I give John Murphy a lot of credit. I read his books. I do follow sector rotation very closely, and anybody who follows the show knows that I will talk about that XLY versus XLP ratio. To me, that's the most important ratio in the market. And you were showing it, in terms of, you were showing it visually on that wave, that cycle chart earlier, where you've got consumer discretionary or cyclicals on one side and you've got consumer staples on the other. And I think that relationship is probably, I don't know if it's the most important, but it's certainly one of the most important, because when you think about our GDP, 2/3 of it is consumer spending, and where that money is being spent in which areas, whether it's consumer discretionary, which are the things that we want, or consumer staples, which are the things that we need. I think the relationship there is incredibly important. And I thought that chart that you showed early on really ties that together, and why you want to kind of look at those two to see which is leading. Because if you pull up an XLY to XLP ratio chart, which is XLY:XLP, and then you also drop the S&P 500 in a separate window below or even behind that chart, what you're going to see is that the two tend to mirror each other. So for instance, when the consumer discretionary starts to underperform the consumer staples space and the S&P 500 keeps going up, to me, that's a warning sign. You want to really be careful, because the market underneath the surface is starting to rotate in a fashion that normally is not bullish, even though if you're looking at the S&P 500, everything seems fine. You're going to hear all the cheerleading on CNBC, but it really is more important what's going on underneath that surface. I just wanted to kind of follow up and talk a little bit about that, because I thought that was a great point.
Yes, no, I agree. Again, those are at opposite ends of the cycle. And frankly, you could look at other sector pairs that are kind of at opposite ends of the cycle. I think those are the two strongest ones and the most important ones to look at. But some of the other pairs can also be interesting. But thank you. You also reminded me one other thing that I want to point out before I go, which is this particular chart. Not only does it automatically go into histogram mode for you if you select the S&P sector ETFs, it also uses the S&P 500 as a baseline. What that means is that these percentages you see here are the percentages above or below the performance of the S&P 500. This doesn't mean the technology on an absolute basis over the past 200 days is up 10.4%. It means it's up 10.4% above what the S&P 500 did. So see how I've got the S&P 500 box here clicked in gray? If I unclick it, now those are absolute percentages, but clicking it, this is the relative percentages essentially above how they performed above or below the S&P. And that's super important for sector rotation. You want to make sure you're not looking at the absolute performance of the sectors, you're looking at how they did relative to the market as a whole. So thanks for reminding me of that.
Yep, and then that slider down at the bottom, if you shorten that from 200 days down, you can obviously start to see, you can begin to see in the short term, is that relationship changing, which is really important.
Okay, well, I'll leave it to you guys to do the rest of the show. How's that sound?
Sounds good. Have a great weekend, Chip.
Thanks.
And thanks for stopping by.
Indeed. Excellent. That was great. And for those of you who are interested, that business cycle graphic that he showed earlier, you can find that just if you go to search under sector rotation and just go to the Chart School article. It's right there. It's right in there. I will also have these charts in the Market Watchers Live recap. So you'll have that available as well to get that particular graphic. So, and with that, I think it's time to move in some chart breakdowns. No, we're going to go breakouts. Last time we did breakdowns because, well, let's face it, the market was on its way down. But right now we're having a decent day. So we actually do have a few chart breakouts. So I'm going to go through a few. And Tom, I think you're going to go through a few. Here we go. So actually, I picked out a bunch of them. And I got these really from just going to the member dashboard and using a couple of predefined scans just to, look at some various areas that would help me find some breakouts. And that was, strong volume gainers. That would be gap ups or breakaway gaps. So I basically went in there, and I think I also looked at parabolic SAR buy signals. And so when I went in there, I just sort of flipped through some of those charts, and I was trying to find charts where you had either a basing pattern or a really nice breakout from a declining trend. So with that, that's what I want to show you. And here we go. So I'm going to go through them. The one I liked of all of these, the best, was Ellie Mae. So I'm going to show you that one first. I thought this breakout was pretty impressive, but I also think there's still more upside potential. So usually you get a breakout like this and we look for the pullback, and I would still, hope for the pullback. But what I wanted to point out is that, we broke out of this area of overhead resistance, and now we're heading back up to close this gap. And that would bring us up here into that, 110 area. So I think there's still a lot more in the way of upside potential for Ellie Mae. This is in the software space. So this was one that I was looking at. I thought that one was very interesting. And let me just flip through these others fairly quick. So this one, I noticed that it broke out from a short-term declining trend, and it's headed up to, test this other declining tops trend line. And there's also at 28, there's some horizontal resistance coming up. So yes, there is some resistance coming up, and it is kind of coinciding together. So I would be interested in seeing a breakout a little bit higher, but I think, looking at this PMO, we've been pretty flat, moving sideways, and now we're getting that bump to the upside. So I think there's still some upside potential here for B&G Foods. Cardtronics. Look at the very interesting big breakout here. And yeah, it is a 12% move, but I think the upside potential again is pretty good here. And we're seeing the PMO breaking out from this declining tops trend line. So I liked that. It would be nice to see a bit of a pullback, but I think the upside potential is still really good up here to 34 at this area of overhead resistance. And let's see, I'm going to bring up a weekly chart real quick. And again, look at this very important line of resistance that is being broken this week, that $28 line. So to me, this is a pretty nice breakout. I think there is a lot of upside potential for Cardtronics Incorporated. 5.9 Incorporated. I'm 5.9. All right. This one, we had the breakout earlier. and it came back down. So we got the pullback. I noticed that, we got a closure of this gap after we had that move up. So it's already closed and now it wants to head back up. I think this one could be interesting. Look at the PMO buy signal here. Scooter just moved into the hot zone. So I think there's some pretty good upside potential here up to that 34 line to get back up where it tested 3 days ago. So I liked that chart. Parsley Energy, PE, again, nice breakout above overhead resistance. I got a PMO buy signal. It did give us a little bit of a fake out breakout. And this one I think is worth looking at to see if we're at if we're in really overbought territory for that PMO. Because a lot of times if I see a buy signal at the top of the PMO channel, I do kind of stand back and want to watch that a little bit. So what I'm going to do to find out what's going on with the PMO is I get a 4-year chart so that I can see the oscillations of it and kind of come to a decision as to whether we're at the top of that trend or not. And I think it'll be easier if I draw this in. All right, so we started back here with a pretty wide range when you go back to the beginning. But what I want to see is kind of at the typical low. So the typical low is at -5, which means the typical high is going to be about 5. So we're in an overbought territory. However, we can see on a nice run, the PMO's gotten up to 7.5. So this wouldn't bother me overly, but it's still something to consider on that breakout. And a weekly chart, and then I'll pass it to you, Tom. Again, that's a pretty nice area of a breakout. You could make a case for a double bottom possibly here. I think there's still some pretty good upside potential. That 33 level, though, might be an interesting level of overhead resistance to keep an eye on. With that, I'm going to pass it back to you, Tom. And I think that was the majority. If you want to go look, let's see, XHE was one. You can see it's broken out from, the highs for the year, the annual highs. So I thought that one was pretty interesting. And PMO is rising with the trend. And then Super Micro Computer. This one's kind of a big breakout. So I would certainly want to wait for it to come back down, pull back a little bit, although it's just now coming above that 200-day EMA. It failed before, so I think it's worth a watch to see if it will fail again. And there you go, Tom. Did you find a few?
Yeah, I got a little different way of looking at it. First, I just want to mention I'm 5'9" as well. So boom, there you have it. Must be karma or something. Maybe we should be investing in 5'9" today.
I know.
But anyway, I've talked a lot about the dollar rising, and this is the S&P 600 small cap index. And you can see off of this uptrend, it's got a really nice looking ascending triangle pattern. So this is a bullish looking chart, and it kind of fits with the theme of a rising dollar going down the road. So what I wanted to do was show you some of the areas of the market, different sectors, but the small cap area. So for instance, the ticker symbol PSCD, this is the PowerShares S&P small cap consumer discretionary portfolio. So you can see what consumer discretionary is doing within that small cap arena. And then down at the bottom, I've got it compared to the small cap index. And so here it's kind of, it's not bad. It started to strengthen again, but we're not in breakout mode, certainly. And then I wanted to go through a couple of others. I'll try to make it quick so that we can take a look at a couple of stocks. But next would be the information technology. And here you can see it's just been going sideways and on a relative basis, not performing very well. Then you got the PSCF, which is the financials, trying to make a push here to the upside, but again, on a relative basis, underperforming other areas of the small caps. And PSCI, this is the industrials, really fallen apart here in the last 2 or 3 weeks. This is a group maybe to keep an eye on, but for now, I would avoid because they are being shunned by the market. This is the group, though, that looks interesting to me. Small cap healthcare. It's been continually rising, and look at it relative to the small cap index. Very strong. So what I would do, knowing that and having that knowledge, if you go back to the member dashboard and come down here into your Scooter reports and then go into the small caps, and in this search table, type in healthcare. And it will bring up those stocks that are small caps in scooter rank order. So you can start at the top, and this will give you the best rank. Now, many of them are biotechs. You got to be careful with some of these small biotech, small pharmas. I'd probably maybe be a little bit more interested maybe in the healthcare and medical equipment. Let's take a look at Star Surgical, for instance. You can see a huge breakout yesterday. So yesterday, obviously, if you had caught this with the increasing volume, it could have been a breakout type of a play, certainly a chart breakout. But instead, what I would do is maybe go down, and I was looking down at around the 80s. Actually, maybe the best way to do is look at it from the change standpoint. So these are what the scooter rank has done today on small cap healthcare stocks. And so some of them maybe that have risen, not so much. The problem is if you get the ones that have risen a lot, that means that they had a really low scooter rank before. So they're probably not breaking out. And if they are, they've probably made such a huge move that you're probably not interested. But I was going down looking through, and I saw, for instance, Atracure, which is a medical equipment company. The scooter rank currently is 83, so it's a really strong scooter rank, and it is up 5. So maybe this is one that could potentially be breaking out. And I looked at it, and there you go. You got a breakout a few days ago, came down, tested the 20-day moving average, starting to move up again. Just be careful, make sure you're comfortable with the volume levels. But ATRC was one. I think, let's see, there was probably Massimo, MASI. On this chart, you can see it trying to break out above that January high just now. And look at the volume, is that it's been soaring here recently to the upside. Another potential chart breakout there. And let's take a look maybe. Actually, I want to go down and take a look at BEAT. I think that's down a little bit further here. There it is. All right, I'm not even going to try it here. I'm just going to call it Bio. But look at the sideways consolidation here off of an uptrend, which I like. This is earnings. I remember because I was just looking at earnings reports recently. But here was a breakout with earnings on heavy volumes continuing to move up. This is a type of stock. It's in the right space. It's a small cap, which is outperforming. It's a small cap healthcare, which is outperforming. They just beat top and bottom line. They broke out of sideways consolidation. If I could get this stock cheaper, this would be one that would have my attention. So that's the way I would kind of use the, to look at chart breakouts, is to find a theme in the market of what's working, and then use the tools, all the vast tools that you have here at StockCharts, to quickly identify some possible trade candidates. And I think using that scooter report, we talk about it all the time, but I think that's a really quick way to identify some of the stronger stocks. And if you're looking for chart breakouts, high scooters is certainly one area to look at. So with that, why don't we do a quick recap before we get into the 10 and 10. And you can take a look at what Aaron had discussed, what I've discussed, some of the stocks. Hopefully we'll get that up here in just a second.
There it is.
And yeah, there were a number of stocks that we talked about, different ways to go about finding them, and some individual trading candidates that you might be interested in as well.
Yep, exactly. Watch lists. And, somebody had mentioned in the chat room, Tom, that if we're in the middle of earnings season, are breakouts less relevant? Because Tom has proven that breakouts on earnings beats frequently don't hold. But I would say, as you do, though, if you get an earnings beat, you add it to the watch list.
Yeah, I always I go through Zacks. I use Zacks to look at revenues and earnings. I look for beats on both top and bottom line, and then I go to the charts. And if they beat on top line, they beat on the bottom line, and I like their chart, very similar to that BEAT stock I just looked at, they go on a watch list. It doesn't mean I just jump in at any price. Then it's a matter of trying to get my price. It's no different than sitting back and waiting for something at I don't know, one of your favorite department stores to go on sale. I mean, you want to buy it, but you don't want to overspend. So you wait, and when it pulls back at some point, and it'll pull back at some point, or if it doesn't, there'll be many other stocks to trade. That's when I would be more interested in pouncing on it.
Right. All right. And with that, let's go ahead and move on into the 10 and 10. I pulled them all up in a correlation to the S&P over the last 20 days. just to see, interestingly, which ones are traveling in the direction, similar to the S&P 500 in the relative strength. So what you can see is we had a few of these that are pretty much not going with the S&P. And something to consider is if you have a basket of stocks, if you're feeling, bearish in the short term, a lot of people like you, Tom, you step back out. But if you want to be a little more aggressive, this is where you could find possibilities, is when you've got those that are negatively correlated with the market. And then, RRG, when Julius talked about, you find two that are going in the opposite direction. That way you could even set yourself up with a hedge at the same time. So these are just some interesting, I thought it would be some interesting looks here. Pandora is traveling right there is right there in the middle. So it's not doing anything on either direction. So anyway, let's get started. The first one is Goldman Sachs, Tom, and the next one is going to be the most popular in the chat room. So start doing your likes in there, and we'll see what the next symbol will be.
All right. Well, Goldman Sachs, and I've talked about this one before. My problem with Goldman Sachs is not that it's not in a good space. I think it's in a good space. I just don't like it because it hasn't been a good relative performer. Here you can see, I mean, you can call it a head and shoulders if you want. It's a little sloppy, but a left shoulder, neckline, a head, right side of a neckline, right shoulder, and a breakdown, volume picking up on the breakdown. I mean, it just doesn't look good. You want to see that broken resistance. As we move higher, we had the volume. It's just come back down and it's failed to hold. When you look at the investment services index, we're not seeing a breakdown below that February low. So you can see right there that on a relative basis, Goldman Sachs is not a good performer. And that's exactly what this line here shows you, that among the investment services stocks, Goldman Sachs has been a laggard and has been a laggard for quite a while. And if you look at the Goldman Sachs versus the S&P 500 ratio, it has fallen off a chart here in the last few weeks. So this movement to the downside and losing these prior lows, the overall market hasn't done it. Its peers haven't done it. And so Goldman Sachs to me is just it's a stock within the market that, is it at a major support level? I mean, it did print a hammer yesterday. Maybe it's going to bounce, but I would be watching overhead resistance around the 20-day and that price resistance at 245 to see if we can get back through. I think there are better alternatives out there than Goldman Sachs. So I like the area of the market, but I think Goldman Sachs is not the stock that I would turn to.
All right. And the most popular request in the chat room is Textron in the industrial sector, TXT, aerospace.
Yeah, I really like this chart. This is one that beat my earnings, went all the way back down, tested the 20. Look at that hammer right on the 20-day moving average and price support. So I was just talking about you get the earnings beats and you put them on a watch list and you wait. I think that's a perfect example. Huge volume, gap up, way above resistance after sideways consolidation. Then you get the pullback. You hold your 20-day moving average, you hold price support, and now you can get in with a fairly tight stop. You could use 61. Maybe you could use the bottom of gap support at 60. Maybe you accumulate it both. But, if it moves down below, say, $60, I'd be out of the stock. Otherwise, I'm looking for it to go back higher, and I think it's starting to do that now. I like TXT.
All righty. Another one that was pretty popular, I think I want to throw it in there, is NVIDIA. I'm liking this chart. I see a double bottom. I see, that break above the 20 and 50-day EMAs. Yeah,
I mean, it's consolidating. We've seen some of this before. I feel a little better if we take out that April high. The problem is, and not to say anything about the PMO, because I feel the same way about the PPO or the MACD or any of the momentum oscillators and the moving averages. They work a lot better when you're in a trend. When you get into this sideways consolidation, you get whipsawed. You can see the PPO breaking above its trigger line, breaking back down below, breaking above, breaking below, breaking above, below, above. You kind of get that picture. And look at price action. We're going nowhere. So I think that the price really is the key. So the first area that I want to see NVIDIA get through is 238, but really the big one ultimately is going to be up at 251. So if we can break 238, I think we make another run perhaps for 251, 252. I would take profits at that level and see if we can get through, because again, you can see how many times we've gotten up around 250 and we failed. So I wouldn't just make the assumption we're going to get through. I like the chart because I do think that off of an uptrend, it continues to consolidate, but it is in a range. And I'm going to say right now, for me, the range is really from about 214 up to about 251. So if you get in here, you got to decide, are you going to use that 20-day moving average as your support? Because it hasn't really been a great support for quite a while. That's why I like to get them either closer to price support and then get out closer to price resistance. But NVIDIA, again, longer term, I like it. Short term, I think that we're still in the middle of all this whipsaw.
All righty. Yes, flat PMOs. You're right. Trendless markets. It shows you no acceleration. Very true. All right. The next one, Salesforce.com, CRM. Tiny breakout today.
Yeah, I like it. I mean, it's continuing to put in the higher highs and higher lows that you look for. I think this was also a stock that came out with pretty good earnings last time. I'm going to just, oops, that's not what I wanted to do. You know, for me, kind of watching this trend line in here, you might keep an eye on that. Also, whoops, definitely don't want that. Right there is your resistance. So I think we're squeezing. The rising trend line here maybe offers up some support around 119. You could even use this recent low, maybe around 117 on a closing basis. The upper end of the resistance is going to be at 128, which was that March high. I think we continue to consolidate, ultimately break out. But again, as a short-term trader, as we get close to 28, I'd take my money.
All righty. The next one, let's see, Blackstone, BX.
Yeah, BX also in that financial space, but not performing very well. We are starting to see a little bit more volume here. And again, we're trying to break out. Look at that long tail yesterday, though, which I don't like. We're back up into the range again. I'm just going to say, you know, things would start to strengthen if we can get through. I'm going to say 32.25, maybe even, you know, because it connects so many of these lows over here, maybe that 32.5 area. Let's get a breakout above 32.5. Then I think we got a shot for maybe 34.25 to 34.5.
Okay. Let's see. The next one, Zillow, Z.
Z, that makes it easy.
Easy.
Z just makes it Z, but you know what I mean. Zillow, big gap down here on very heavy volume. So that means we got some gap resistance that could be filling here. So I'm going to be watching closely to see what happens when we get up to about 53.50. That's where we gap down on very heavy volume. We're making this run up. A lot of times, though, you will see failure come in at that gap resistance zone. So the other thing to watch is the volume. You can see volume was picking up on the move through the 20. Yesterday, it tailed off a little bit. Today, it's much lighter than it was yesterday. And we are beyond the halfway point of the day. So we're probably looking at about 1.3, 1.4 million shares. We're almost 2.5 million yesterday. So the problem is, as we're coming up, we're losing the volume and we're getting ready to hit major overhead resistance. I'd need to see Z clear 54 with some volume. Otherwise, I would actually be looking for maybe a reversal at the 53.5 area.
All right. The next one, media agencies industry, QNST, Quinn Street.
Yeah, this is one actually I traded quite a bit for a while. And I know with their, I think it was their earnings took them down. Yeah, I think this was their earnings report here. But they had broken down a little bit even before that, had gone down, reset their MACD, or excuse me, the PPO, and then finally broke down. And you can see the volume come in on this push to the downside. Now we're trying to recover. And honestly, we're back at gap resistance from the earnings. So I'd like to see a little bit more out of it. That's where we closed before this heavy volume moved to the downside. And look at where we are. We already failed once coming up here with a big red candle afterwards. I'd like to see it get through before I'd be more bullish. You know, if we can get through that level around 1230, get up to the next level, which is 1280. I think this is going to be the key resistance zone on QNST in the near term. If we break through, then I would look for a move up to test that 1450, 1460 area.
All right. For our Canadian friends, we haven't done a Canadian one in a while. Maxar Technologies, MAXR, Breakouts.to, and this is in the computer software and processing industry.
Ugh, yuck. Yeah, I can see a lot of things that I don't like about this chart. I don't really see much that I do like. First of all, the stock was 75 and in 2 days went down below 60 on very, very heavy volume. Looks to me like major distribution. I'm not really seeing signs, and I know you can say, well, here lower prices, higher PPO, here lower prices, higher PPO, here lower prices, higher PPO, and the beat goes on. The problem is that when you get a really big drop like this, the PPO takes a big turn to the downside. And unless you keep up that kind of a drop to the downside, you're going to start seeing positive divergences form. These are not, I wrote an article a long time ago about MACD secrets, on the MACD, same thing applies to the PPO. But when you get big moves to the downside, you get sudden large moves down in the PPO or the MACD. And if things just start to slow down, they can still be very weak. But just the fact that we're not going down 25% in 2 days means that the PPO starts to turn up. That's a false positive divergence in my view. Check out the volume on these moves to the downside. Look at when we set this new low. Look at the volume. That is not slowing momentum. That's a lot of selling that's still taking place. I don't like the stock. I would, maybe you can look at it and see, maybe you might want to make the argument that the selling is finally beginning to slow here, but I'd have to see some strength come in, maybe some sort of a breakout before this one would get my attention.
All right. The next one is Etsy. We haven't looked at that in a while. I wish I could say that I got back in it, but I did not.
Yeah, I was looking at that one not too long ago. It came up on a scan. I think it had a negative divergence, but let me pull it up and see. No, it actually doesn't. It does have a negative divergence, but it's consolidating. You see the PPO is now back fairly close to the center line, not quite there. But it does have a nice pattern still in play. I mean, it's moving up to test highs. It did try to make a breakout the last 2 days and failed. So maybe we get a pullback. I doubt we would see much below $28 to the downside, though. That's the recent low. That would essentially reset the PPO. I think the price action would move back to the 50-day, and I think your PPO would then move back to the center line. And at that point, I actually think that this is in sideways consolidation mode. And so 28 and a half, if it does pull back to that area, would represent a great entry point. The flip side would be a breakout. What you're looking for, if it doesn't pull back, you'd be looking for a heavy volume breakout above $31 with a close above that level.
All right. Let's see the next one, IPGP. Of course, that is IPG Photonics. I like the flag. That short-term flag is interesting to me.
Yeah, in the near term, I like the spike in the volume. Get a breakout above 235, and then you got the flagpole. You got a nice measurement potentially on this one as well. I'm going to pull up the, let's do this last one because I think this is the 10th one. Let me do it on a relative chart.
Number 9.
Oh, thought I had, I think I've got 9 already. I thought this was 10.
Really? I wonder which one I gave you that I didn't write down.
Okay, so we got a beautiful move up here with IPGP, sideways consolidation, although I would have liked to have held 220, but we did come right back up above that level with some volume. I don't know, maybe if Bruce was with us, Bruce Frazier, he might look at this as maybe a spring where we go below, the volume's not very great, and all of a sudden we shoot back up. So there's definitely some bullish arguments to be made here. I think IPGP relative to its peers is doing okay. Versus the S&P, it's been sideways now for several months, but that comes after an uptrend, so that's fine. If there's one downside, it's just that the overall group itself is not performing particularly well. But this stock is one of the better performers within the group, or at least I would say in the upper tier. So there are some positives here, but I think at this point with it having overhead resistance, which I'm going to mark, being that most recent high, and then also the 50-day moving average, I'd like to see that breakout. I think if you get a breakout above about 238, I would look for a move back up to test 260. If not, if we fail to hold there, let's watch this reaction low off this big candle down around 225. So I would say 225 to 238 is your short-term trading range. Let's see which way it breaks first.
All right. And my producer, our producer, said that it is 10. So I trust the two of you for sure. So
Probably
here we
I
go.
don't know about trusting me, but trusting the producer is probably a good
Yeah,
idea.
absolutely. That's what I said. Okay. So there are the symbols for you, and I will get those up in the Market Watchers Live chart list, and you will be able to access those charts with the annotations right from there. Just click on them. And, you know, when Tom does those relative charts, that's also a way for you to get those settings. You just find one of those in the Market Watchers Live chart list, click on it, and then there you go. Save that as a chart style. But right now, it is time to talk about August. So let's get to it. And here we are. So if you go to stockcharts.com/chartcon, it's our giant charting conference, hence the name ChartCon, and it is online. So for those of you who haven't heard, you can go to the conference from your very own chair, seat, couch, whatever it happens to be, and watch all of it live. Or, you know, once you register, if you have something to do that Saturday, it's okay. You can join the program live when you're free, but then you have the access and the history of the other presentations, and you get to keep that. So it's still an excellent thing, and it's great. Again, if you can't travel, it's an excellent way to keep in touch with what's going on here. And the presenters this year are just fantastic. The early bird special for registering is going to expire tomorrow. So go ahead and do it. And I can guarantee that probably from one or two trades that you learn something from this particular conference, you will make back that $200. So I think it's a fair price there.
It's an investment.
Excellent investment in what you're doing in the future. So think about it that way. It's something you should definitely consider.
And in many cases, it would be a tax write-off as well. Check with your CPA.
That is a very good point. We should have been talking about that a long time ago. Okay, so let's go ahead. I'm going to take us into our candle glance for a final market update. All righty. Let me update. This is the way you can change that if you want to add a few things that instead of what's there. I'm going to put Apple in here just for grins, since it's one of the big movers today. All right, so as you can see, I mean, I woke up and I got the news that the Dow was down 100 points, that even though Apple was higher, well, obviously that didn't last, and we're having a really nice rally today, continuing this rising trend that started around just before lunch yesterday. So keeping up with that rising trend, maybe this is that place it's going to bounce. As I wrote about, I think yesterday, in my DP bulletin on the S&P, which I just got a PMO sell signal on, this is the place. If it's going to rebound, this is the place it needs to do it. We're on this rising bottoms trend line. We've got the 200-day EMA here. If we pop down there below any either of these levels, that's when I'll probably raise my hand and finally step into the bear market camp. At this point, I'm kind of in the role of neutral, that we're in a correction. I'm with you there, Tom, but I'm leaning on the bearish side right now. So I've not been racing to put my money in the market at this point. Let's see what else we have to say. USO commodities are up, forming a flag right now. So that could be interesting. And we've got the dollar gapped up, but it's coming right back down toward yesterday's close. It's up slightly. And gold really choppy trading today, but it is angling higher. We're near the intraday highs currently, GLD at 124.49. The VIX is continuing lower. And, when I looked at my ultra short-term indicators here, that's usually a bad thing for the very near term. And, you get people too complacent. This is a sentiment indicator. And so when I use it in the very short term, I mean, it's good to have everybody feeling pretty comfortable, because in your you're likely to see some buying. But what happens is when it gets stretched back down to where people are just really comfortable, that's generally when you're going to see a pop in the other direction. And in this case, I would expect another downside pop tomorrow. So we'll see tomorrow, then I mean Monday or Tuesday. Yeah, tomorrow it's not going to do anything. And Apple, as we see, you know, we've heard that Warren Buffett's accumulating again with Apple. So it's obviously having a great day. And I'm sure the talking heads are going to be talking about how it is driving the entire market higher. I don't subscribe to that, but certainly a great excuse to talk about. And with that, I'm going to conclude our final market update. And well, goodness, it's time to get into sentiment. And I think it's very, very, very interesting right now. I always think it's interesting, but I think it'll be very interesting to all of you as well. No, that's not where I want to go. This will work. All right, and this is the list of the sentiment indicators I follow. Some of these we don't look at just because when they update and the time frame. All right, so this is coming in blurry. So I find that when I bring it back down, there we go. I want to make sure everybody can read it. All right, so if you recall, I always give this little tutorial at the beginning of all of my sentiment reports. But remember, sentiment is a contrarian indicator. So when people are very bullish, that's actually bearish because everybody's getting on board. And generally when everybody gets on board, the bandwagon, the wheel falls off. And so we like to follow sentiment for those extremes so that you can see when people are too bullish or when people are too bearish, and look at it as far as contrarian for the market. So if investors are bearish, that's good for the market. If they're bullish, that's bad. So what I'm looking at here is the put-call ratios. And what we look for when we want to look for something good to happen or something bad to happen, I start looking at troughs and at peaks. And right now it looks like we're trying to bottom at this point. And generally when you see a bottom like this, it coincides typically with a little bit of a rise. So the put-call ratio, if it's getting lower and lower, that means that there's more and more calls being made out there, if that makes sense. I know that there's a person on either side, but the way that they calculate the put calls. So if you get lower and lower readings, that means people are getting more and more bullish, and that's actually somewhat bearish for the market. But I'm not seeing that trough happen. I think we could end up seeing these ratios go lower. I'm actually looking for, out of this chart, I think that if we get that bottom, of course, that's bad, but I'm not so sure we're right there just yet. I'm going to look at AAII. This is American Association of Individual Investors. You can go to their website, and I believe anybody can vote whether they are bullish or bearish and or neutral. But to me, why do you bother taking it? Either you're bullish or you're bearish. But no, they also, of course, count the neutrals. And I do pay attention to that because if you have a lot of people on the sideline, then as far as their sentiment, there's uncertainty, and that's pretty much neutral for the market. So I do kind of pay attention to that as well. But what I wanted to point out, especially when I'm looking at this particular chart, is we do see in the thumbnail, it's a little easier to see, we're getting a slight increase in the number of bears, and we're seeing the bullish sentiment pulling back just a little bit. But the interesting thing to me is that the ratio is now below 1. And that means that we have more bears. And the more bearish that gets in the denominator, the lower that ratio will get. And then we get these very low readings. And what you want to see are these very low readings. When people get very bearish, that's good for the market. And you can see that we are seeing some, it's now gone below that 1. And typically you do see a bit of a rally off of that type of sentiment. I think we could certainly get more bearish at this point. And really with a day like today, I would expect to start seeing the bulls start to increase at this point. But this is for these numbers come in. It comes in yesterday. They came in yesterday, so there is a bit of a lag here. All right. Next one we're going to look at is the National Association of Active Investment Managers. This tells us how exposed they are to the market. And so we watch for their exposure levels to move way down, because typically that is going to come in at the front of a rally. And what I'm noticing, I drew the line right here so you can see where it is currently, that reading. And as far as this year, or the last 2 years, really, we're now at readings that are, as far as exposure levels, are very, very low. Now, we've seen them get more extreme previously in previous years, but I'm paying attention to this right now because that tells me that as far as recent data is concerned, we are seeing some very low exposure numbers. And so that means that these active managers are feeling bearish, and sentiment being contrarian, that is bullish for the market. The last one I want to look at is our Ridex asset analysis. Ridex is a company. They had a group of funds, bear funds and bull funds and sector funds, and then they also had money markets. Well, Guggenheim took it over, but we kept the name. And so what I do is I watch, we record the assets every night in each of the bear funds, money markets, and the bull and sector funds. And by doing that, we can see where the assets are going, where the money is going. Not necessarily, yes, raise my hand, I'm bullish. No, I'm going to put my hand down. No, I'm bearish. That's great. That's easy to do. But what we want to see is where the actual money is going. And that's really what this chart will show you. And I think it's a particularly good indicator. So what I wanted you to note is that right now, as far as the bear funds, we're still pretty flat, but we are in a rising trend now. So we're seeing a little bit more money go into the bear funds. We can see a little bit more. We still have a rising trend on money markets, but we're flat as far as the bull and sector funds. So I prefer to see money coming out of these funds to make this a particularly bearish chart, but we're not seeing that just yet. So I would say that this is somewhat bearish for the market, because we are seeing, somewhat bullish for the market, because we're seeing an slight increase in bearishness, and sentiment being contrarian, that's bullish for the market. So let's go ahead and let's look at the summary chart for what we just covered here. And I will have this in the Market Watchers live recap, so I don't want to read the whole thing to you. But put call ratios, I'm seeing neutral to bullish for the market. They're trying to bottom. Bull bear ratio is below 1, and that's bullish for the market, because you have, remember, there's more bears than bulls. And we have the name readings, exposure levels tell us that's bullish for the market. They're moving down very low. And then finally, the Ridex ratio, we're seeing somewhat bullish for the market right now. I'd like to see equities, see some money pulling out of that to make it, see more bearish activity there. But I don't think we're going to see that. Sentiment, I think, is getting more bearish overall. And of course, that is bullish for the market. So going into next week, as far as sentiment is concerned, there is it is setting up nicely. And so with that, I am going to pass it to you, Tom, and wake you up, and we can talk a little bit about what to expect as we close out this show.
Yeah, I was looking at, the VIX and the VXN, and just trying to compare, looking at the correlation, because normally what happens is when you get the S&P 500 going higher, the VIX goes lower, and vice versa. So there's normally that inverse correlation. And I was just looking back into the last bear market, and I thought, it was kind of interesting. I thought maybe I would share it here. Okay. While we're talking about sentiment, I think it's a good time.
Oh, absolutely.
But the volatility index, now this was back 2006, the middle of 2006, all the way over to the middle of 2009. So it fully engulfed that bear market that we went through. And a couple of things, I try to learn something from each one of these bear markets. And one thing that you normally see, first of all, here's the correlation down here. This is the volatility index, the VIX, versus the S&P 500. And you can see that normally we have almost a -1 negative correlation, meaning that they move exactly in opposite directions. But it's not all the time, and you can see a lot of spikes. But when you get spikes and it goes into positive territory, I noticed that we did this in 2007. And I also noticed that we did it. In fact, let me see if I can just, I know this chart's going to really be somewhat of a mess here, but I'm going to just see. I don't want to do weekly. I want to keep it daily if at all possible. But let's see if we can. I just want to look for spikes in the correlation that go above 0. Because I think sometimes when the market is on a roll to the upside, when we start getting spikes, I think it could, I'm not saying it does, but it could begin to lead to some possible tops. And I'm just looking here, in this case, where the S&P is going up in the middle of 2007, we're also going up on the VIX in 2007. So the correlation all of a sudden turns positive. So as the market is going higher, folks are getting more nervous. Premiums on options are getting more expensive. It's usually the other way around. So I thought that was interesting when the market is setting new highs to have a positive correlation with the volatility index going up with it. And if you look into the highest reading we ever got was at the beginning here of 2018 with the S&P shooting up higher and volatility beginning to rise with it as well. So I just wanted to throw that out there. I think it's something that's interesting, maybe worth discussing, maybe worth looking at from time to time. But in the midst of a bull market, I think seeing a rising VIX can be a little bit of a warning sign. And anyway, I just wanted to mention that.
Yeah, absolutely. And gosh, it's time to wrap this all up.
It is. Yeah.
It's
the end of a week.
Yes, it was a great day. I love Fridays anyway, but getting the everything stock charts, information about the sector rotation, I thought was great. And, having a rally today, I think helps everybody feel a little better going into the weekend. And which days are best for trading days of the week?
Wednesday through Friday.
Wednesday through Friday.
Here we
So
are.
Monday, well, we'll see. Oh, you have to tell me, we have to give our input for the sentiment poll. The poll is out there for you all to take. I will be turning that in to the Wall Street Sentiment Survey. So I want to know, what do you think, Tom? Higher or lower or mostly unchanged next week for the S&P?
Yeah, 15 seconds or less. Historically, the market tends to struggle next week, but I do like this rally. Unfortunately, we've gone up a lot, but I'm gonna say higher next week.
All right. I'm actually going to go into the mostly unchanged category. I think we will see some more rally, but I think we're going to end up with some more downside movement, kind of cancel it out by the end of the week.
All right. Fair enough.
Yeah. And let me just look real quick. What's our poll look like? Yeah, half of you are saying higher. So that's interesting. Next week, we have Tom's workshop on Tuesday. We're taking your suggestions in the survey. Jeffrey Sout will be here for our Wednesday guest. Dan Russo from Chaikin Analytics will be with us on Thursday. So that'll be a really interesting show.
Yep.
And there you go.
Yep. I was going to say another great week ahead. We had a great week this week. Want to thank all of our guests for being with us this week. Also want to thank all of you for being with us. Please remember to complete that survey as you exit. As Aaron mentioned, give me a topic for next Tuesday. I definitely will consider anything suggested. And also let us know what you think of Market Watchers Live. We love to get that feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe, and we'll see you back here on Monday. Happy trading.